The novel coronavirus has impacted us all, but where we could hide at home, certain aspects can't adopt this escape route. One such aspect is the economy. The pandemic has reached almost every country in the world. Naturally, governments around the globe are in a state of panic. Many countries found it overwhelming to control the unexpectedly rapid spread of the virus. Hence, national economies and businesses had no other choice but to count the costs. The extended lockdowns to tackle the virus's spread resulted in shutting down many businesses across all sectors, which further impacted the economy. So, how and to what extent has the COVID-19 affected the global stock market and economy? Today, we'll find out. The economic impact of the pandemic has been a surprising one, and, interestingly, it continues to surprise. In the spring, we saw business shutdowns pushing economic activity to an all-time low. It wouldn't be wrong to state that coronavirus forced the economy into shutdown. Hence, a brutal fiscal contradiction unfolded, which broke many of the negative records set during the Great Depression. Enjoying this video so far? Please don't forget to subscribe and press the bell icon to receive notifications about our latest uploads. Thanks! Now let's get back to the video. In early March 2020, the Interim Economic Outlook for the Organization for Economic Cooperation and Development, which we'll casually refer to as OECD, highlighted that the pandemic had already caused a sharp decline in China's economic growth. And what followed was a similar downward spiral in almost every country. Governments were prompted to introduce unprecedented measures to control and contain the infection. We cannot object to measures like countrywide lockdowns because these were necessary to contain the virus. However, they have led to businesses facing temporal shutdown, extensive mobility and traveling restrictions, market turmoil, heightened uncertainty, and mass-scale confidence erosion. Stock markets are where company shares are bought and sold. Big shifts in this mechanism usually affect the value of individual saving accounts and the value of pensions. One of the most lethal impacts of the global spread of the COVID-19 virus is that it heightened market risk aversion so drastically to levels we haven't seen since the 2008 global financial crisis. Believe it or not, stock markets declined over 30%, while equities and oil volatilities have spiked to crisis levels. Credit spreads on non-investment grade debt widened greatly as investors adopted a low-risk approach. Global financial markets are facing this heightened turmoil despite the comprehensive financial reforms implemented by the G20 financial authorities. In Europe, the Financial Times Stock Exchange, or the FTSE 100 index, has suffered its deepest plunge since 1987, while in Latin America, stock exchanges dropped dramatically. The Dow Jones Industrial Average and the Nikkei all recorded huge falls, while the number of coronavirus cases grew in the crisis's initial phase. Most major US and Asian markets did recover considerably following the arrival of the vaccine in November 2020. However, the FTSE is still in negative territory. It dropped by 14.3% in 2020, which by industry standards is its worst performance since 2008. The Shanghai Stock Exchange Composite Index and the Nikkei Stock Average Index plunged due to the pandemic. In contrast, the Japanese economy was affected the most by postponing the Tokyo 2020 Olympic Games. The Nasdaq Composite Index and the S&P 500 Index found it challenging to stay afloat in these rough waters. Similarly, the Dow Jones Industrial Average Index has reported some of history's biggest single-day losses, reflecting the global stock market's highly volatile nature. That's why the US Senate had to pass a $2 trillion coronavirus aid bill to aid the ailing economy. In many countries such as the UK, central banks slashed interest rates. This means countries have made borrowing cheaper to promote spending to boost the economy. Due to such measures, some markets managed to recover ground in January 2021, but this is a general trend which we'll call the January effect. Analysts fear that any new lockdowns or delay in vaccination programs may trigger more market volatility in 2021. The intensity of the shock has created widespread economic pessimism, which is another significant pandemic impact. The pandemic generated systematic fears among the masses, but in our opinion, the situation isn't as grave as was being predicted around 6 or 7 months back. People predicted a new Great Depression that will cause the banking system to collapse, price deflation, and bring sovereign defaults. But after a wobble, prices did stabilize and sovereign borrowing costs fell worldwide. However, there has been expansive borrowing, while the banking systems today show fewer liquidity issues. So, we can say that extended systematic fears have remained unfulfilled, as the situation didn't get as tricky as it did in 2008. Systematic fears usually pave the way for cyclical fears, but we have observed that like systematic fears, cyclical fears also remain proliferated. For example, unemployment is a cornerstone measure of economic growth. We expect it to touch an all-time peak in the US with never-ending waves of bankruptcies, a weaker housing market, and a probable collapse by the end of 2021 after initial recovery. But we were surprised to see a promising trend. Although the unemployment rate in the US is still alarmingly high, it did fall sooner and faster. By September 2020, it was lower than expected by the end of the year. The housing sector also showed remarkable resilience, as prices aren't dipping while sales have bounced back to somewhat similar highs since the housing crisis. Most parts of the US economy have now returned to a pre-crisis level of activity, so when the economy shows growth, this means more jobs and wealth for the people. Still, we cannot paint a rosy picture here because all isn't that good. According to the International Monetary Fund, in 2020, the global economy shrunk by 4.4%, which is the worst decline since the 1930s Great Depression. Interestingly, China turned out to be the only major economy to register growth in 2020. Its economy grew by 2.3% last year, but the IMF expects global growth to increase to 5.2% by the end of 2021. Driven primarily by economic bigwigs like China and India. These economies are expected to grow by 8.2% and 8.8% respectively. Conversely, economic recovery in larger, service-dependent economies, such as the UK or Italy, which were also hit hard by the pandemic, will be slower. This isn't an ordinary financial market downturn, as the pandemic's repercussions will be felt for many more months or possibly years. Relief plans like the one introduced by the US will eventually lift economies worldwide. However, investors will remain cautious and want to wait for the virus outbreak to be contained before investing in stocks again. Enjoying the video? Remember to hit that like and subscribe button. Thanks! Businesses in most countries have become heavily indebted, which isn't a good sign for the national and global economies. This indebtedness has made businesses vulnerable to deteriorating markets and economic conditions as a whole. Although there is an accommodative monetary policy in many countries, the low borrowing cost has contributed significantly to the never-seen-before extent of the corporate debt issue. In many G20 countries, the corporate debt stands at an unimaginably high level. At the same time, the growth of leveraged loans outstanding in Europe and the US have offset bank lending slowdown to offer financial aid to indebted corporations, which they will use to buy back shares, pay dividends, and increase the leverage that made them so vulnerable to sharp declines in operating earnings. Lower rated credits like BBB bonds, non-investment grade bonds, and leveraged loans also have risen to elevated levels. It is safe to assume that the global financial intermediation structure has changed a lot during this time. Large banks and broker-dealers are continually providing credit and market intermediation. Market-based finance issued by non-banks has seen a sharp rise lately. Investment funds and exchange-traded funds are now playing a key role in credit intermediation. They're also facilitating the demand for corporate debt by giving liquidity to investors. But we can't overlook the fact that when there's an acute market stress going on, higher levels of investor redemptions can force rapid selling of corporate debt through funding such as leveraged loans and high-yield bonds. This dynamic may erode market liquidity quickly, and the price of traded debt may rise, which will raise businesses' financing costs. Despite these not-so-welcoming changes, we must admit that the global economy's initial bounce back was much more robust and sooner than was expected. Some economic sectors have undergone complete recoveries to pre-pandemic activity levels. Still, some sectors which are mainly vaccine dependent, including recreation, hospitality, food service, and transportation, will take time to bounce back. There have been some positive changes, But overall, meaningful recovery to pre-pandemic activity levels will take time. These sectors are responsible for a large chunk of the global economy. Only in the US, these sectors represent around 38% of consumption. Therefore, solid and sustainable economic recovery depends on these exhausted sectors. One would like to believe that the development of new vaccines will fix everything up in a jiffy. Sadly, the reality is stranger than fiction. The challenges are way harder to address and far different from the previously observed financial crises. The current market fragilities, market contagion routes, and policy implications all collectively call for a sober assessment of the global market's change structure and financial intermediation in the post-pandemic world. But with that being said, I'll see you all in the next video.